There's a popular quote that says, "During the gold rush, it's a good time to be in the pick and shovel business." This idea evolved to become an investing strategy known as the pick and shovel play. The name comes from the California gold rush in the 1800s when gold was discovered in abundance. People rushed in, hoping to strike it rich. But mining gold was tough and competition was fierce. And so many miners didn't make as much as they hoped. However, they all had one thing in common. They needed tools to mine. This meant that merchants selling the necessary tools, like picks and shovels, made steady profits no matter how successful the miners were. This is essentially what the picks and shovels investment strategy is about: investing in the underlying tools, services, or infrastructure that support an industry, rather than directly into the final outputs of that industry itself. In traditional finance, this strategy is applied across different industries. For example, instead of investing directly in a consumer electronics company, which faces intense competition and changing consumer preferences, an investor might choose to invest in companies that produce semiconductors and processors. These are essential for a wide range of electronic devices and benefit from the overall growth of the technology industry. Some crypto investors carry this strategy over to digital assets. For example, instead of directly investing in cryptocurrencies, investors might turn to the picks and shovels by investing in crypto companies like exchanges, mining companies, or manufacturers of mining equipment. This gives them exposure to the crypto industry, hopefully without having to directly deal with as much volatility. Some people think the picks and shovels are certain cryptocurrencies themselves, such as tokens of smart contract platforms. The thesis is that since these platforms allow for other dApps to be built on top of them, investors can focus on the native tokens of the platforms themselves, instead of the tokens of individual dApps on it. They view these native tokens as the picks and shovels, with the reasoning being that the collective growth of the network and its dApps will accrue value to the platform's native token. This brings us to the major perk of this investment strategy. It gives investors exposure to the entire ecosystem rather than a single speculative asset. Therefore, regardless of which specific applications succeed, the supporting infrastructure remains valuable as long as it continues to be widely used. However, there's a catch. The success of the picks and shovel strategy is dependent on the overall growth and adoption of the industry. If the industry collapses or faces demand challenges, so will the picks and shovels. Just like every other strategy, it doesn't guarantee profits and carries its own risks. For crypto, these risks are on top of the inherently high volatility it experiences. So do your own research and make sure it's tailored to your overall financial goals. What are your thoughts on this investing strategy? And if you're curious about other strategies, check out our video on the barbell investment strategy here.